Hello and welcome to today's special presentation, 3 Tax-Savvy Giving Trends for 2024. My name is Elizabeth Harnish, and today we're talking about tax-smart charitable strategies that can benefit your financial plan and your favorite causes. We're excited to have experts from Fidelity and Fidelity Charitable join us, and we're truly thankful for all of you taking time out of your day to join as well. We have a packed agenda and might not be able to answer questions live, but really appreciate all of the questions that were submitted at registration, which helped inform our discussion today. While today's conversation will highlight opportunities to potentially manage or reduce your taxes, I'd like to mention that Fidelity and Fidelity Charitable do not give tax or legal advice, and nothing we discuss today should be interpreted as tax or legal advice. The information we're providing is going to be general in nature, and it may not apply to your situation. If you have legal or tax questions about your specific situation, we encourage you to talk to your tax professional or attorney. As a director in our philanthropic consulting team here at Fidelity, I work with individuals and families like you to develop customized giving strategies that bring your vision to life and help create more meaningful impact. My team and I have deep expertise in the philanthropic sector and have the privilege of working alongside Fidelity advisors to provide even more value to Fidelity customers, as well as the team at Fidelity Charitable. As we kick off summer 2024, you might be wondering why we're talking about charitable giving now versus the traditional year-end season. Well, you likely have fresher perspective of your 2023 tax filings and a greater appreciation for uncovering opportunities to make your situation even better for 2024. By having this conversation now, you can start to identify opportunities that can help you maximize both giving and tax benefits. So let's dive in and meet our panelists. I'd love to start with you, Margot. Margot, could you please kick us off, introduce yourself, and share a bit about your role?
Yeah, happy to. Thank you, Elizabeth. Hi there, Margot Navins with Fidelity Charitable. I sit on our corporate and executive giving team. Fidelity Charitable is an independent public charity that sponsors the nation's largest donor-advised fund program. My day-to-day, I work with companies to provide guidance, insights, and solutions to maximize both corporate and employee impact. And I have been in the charitable space for over 15 years.
All right. Thank you, Margot. And I'm Chris Dodd. I am a vice president financial consultant in Houston, Texas, but work with clients all around the country. I've been with Fidelity for more than 2 decades, almost 25 years. And my role is to help my clients, their family situations, recognize what they want, what they may want to do in the future, offer suggestions to help them improve their financial situation. And guide them like they were family members. This includes talking about values, opportunities, important things, ways they want to give back to our communities and passions.
Margot and Chris, thanks so much. It's wonderful to have you. Let's dive into the questions. So I noted that waiting until the end of the year can potentially reduce the impact that you can have by starting earlier. What special considerations for 2024 heighten this?
Yeah, it's a good question. It's an election year, so that's on the top of a lot of clients' minds. Causes anxiety, uncertainty. Once the elections are over and that uncertainty is, kind of gone by the wayside, the anxiety usually subsides. But during that time, the market is fluctuating. But stocks and bonds, they're always fluctuating, good and bad. The business cycle that we're in, market perception versus reality, world events, they all drive some of our decision-making process, but at the individual investor level, we can't control a lot of those items. So I try to bring clients back to their long-term strategies. How does this fit into what you want to do for your organizations, for your family, for your legacy? So we talk about, long-term versus short-term views. I try not to let the short-term gyrations of the market cloud the judgment sometimes, but reinforce it's important to have a strong emergency fund, income protection for yourself and your family, growth as well, but then some of the variables out there of what do you want to do? Are there some goals and some charities that you'd like to provide for in the future? The other reason we're talking about it now is in an election year, things can change this year, next year, but we also know in 2026, the tax Cuts and Jobs Act is set to sunset. So what that means is for now, we know what the tax rates are for 2024 and 2025, but they're scheduled to revert back in 2026, maybe, right? Depending on who's elected. So could be extended further. They could get shortened. So taking action sooner rather than later makes all the sense. So that's why we're having this discussion a little bit earlier than normal. There have been some recent administration proposals put forth. The Biden administration proposed in April to get rid of a lot of not charitable giving, but a lot of Roth conversion, a lot of capital gains, benefits that are out there right now. So that could also happen between now and 2026.
Thanks, Chris. So Margot, when I'm working with individuals, they often tell me that they feel like their charitable contributions won't make a big difference. I think you might agree with me, though. You don't have to give like Bill Gates to have an impact. What would you say to those listening right now that might feel that way?
So if we look at the Giving USA chart that's up on the screen, this is always an incredibly positive reassurance that together we have a huge chunk of the overall philanthropic capital. If you look at the right-hand side of the slide, the total percentage coming from individuals when you include both individual giving and bequests, it's actually 73%. So this chart is based on 2022 data, hot off the presses. The Giving USA 23 report was released just earlier this week. So total dollars given to charity in 2023, it was $557 billion. Now, while that giving growth did not outpace inflation, the good news is it did remain and continued to remain above pre-pandemic levels. So, Elizabeth, as you know, between natural disasters, humanitarian crises, social justice issues, there is never a shortage of causes to support. And today we're going to share several really simple and actionable ways that all of us can increase our charitable footprint.
Absolutely. So Margot, let's set the ground rules for giving in 2024. What incentives are available to Americans this year?
Yes, so there are potential incentives for both those who itemize and those who take the standard deduction. So if you itemize and you're giving cash to a public charity, including donor advised fund sponsors like Fidelity Charitable, you have the ability to deduct up to 60% of your adjusted gross income or your AGI. If you're donating appreciated securities that you've held for longer than a year, you can deduct up to 30% of your AGI. And we'll click deeper into that in a moment. If you don't itemize, we're also going to talk about strategies that can help you. One in particular is looking at donating appreciated securities. So whether you itemize or not, you can potentially avoid the capital gains tax on any growth of those assets. There are other strategies that can help you if you're typically taking the standard deduction, like bunching. And we're going to ask Chris to take a deeper dive on that strategy.
Chris, what are some important considerations when thinking about those benefits that Margot mentioned?
Yeah, there's a lot of considerations. I think the first one is just knowledge, education. What is the standard deduction for 2024? And how does that impact you versus itemized deductions? And what falls into that? The basics are for 2024, $14,600 is the single exemption. And if you're married, it's $29,200. There's also some increases slightly higher than that if you're over the age of 65, or if you have a status, disability or blind status. So it's just understanding what those rules are, and would it make sense to just take the standard deduction or itemize potentially if you're looking to gift maybe more than that dollar amount out there.
With those benefits in mind, what are some everyday financial planning scenarios where charitable giving could be a smart complement to consider?
Yeah, every situation is unique, but I look at how can you minimize your taxation and give to the causes you're passionate about. So to me, when I have conversations with clients, managing and reducing income, whether that's, bonus that comes in, a high income year because you're doing a Roth conversion, maybe it's because mutual funds you own in a non-retirement account are having a big capital gain distribution. or you're selling a business or property. All of those things can go into play, and if you don't do anything, you're paying taxes potentially on that. But if you could give cash or appreciated securities, it makes sense to consider that. Some of the other considerations, especially in a year when a loved one passes, a spouse passes away, you're on the joint income tax tables for that tax year, but the very next year you're on a single tax table. So now those standard deductions are reduced. Getting over some of those hurdles become a little bit harder.
Thanks, Chris. And Margot, what is the first underutilized strategy that people should be doing when giving to charity?
Absolutely. So if you all walk away with one thing, and I trust you're going to walk away with more than, one good nugget of information, but if you leave with one thing, and you might even write this down, I always encourage people to give the right asset at the right time. So the most common way that people give to charity is they give cash. You plug in your credit card online, you stroke a check, you give with Venmo or in a Facebook fundraiser. The drum I've been beating for 16 years at Fidelity Charitable, and my challenge to all of you, is to step away from your checkbook and put down your credit card. There is another and very oftentimes better way. So I see donors giving all types of assets: stocks, bonds, mutual funds, private business interests. We see a lot of restricted stock. Very interestingly, we even see cryptocurrency donations. In the first 4 months of this year, we saw over $300 million come into Fidelity Charitable in the form of cryptocurrency. And that's nearly the same amount that was contributed in all of 2021. So when you think about this wide variety of assets that can be candidates for charitable giving, the real secret sauce is in the power of appreciation. And as I mentioned before, that power of appreciation, it can benefit both those who itemize and those who are taking the standard deduction.
And Chris, how do you talk with your clients about donating beyond cash? Can you walk us through an example of that?
Yeah, I sure can. It's one of the most common, and Margot brought it up, misconceptions is you have to write a check or give cash. And that's not the case. So if we look at the screen, we're just going to show one example, but Margot talked through the assets on the left. So let's put this into the practice out there. Let's say you have stock, it's worth $50,000. You purchased it for $20,000 or inherited it years ago, and you're considering making multiple donations to various charities that total around $50,000. Maybe not right now, but maybe over the next few years. And you're trying to understand, is it worth giving the stock directly or donating the cash? And we're going to use an example. If you're in the highest tax bracket, you may be assessed both capital gains at a rate of up to 20% and potentially a Medicare surcharge, 3.8%. And when we start looking at that, if you were to sell that security, pay your capital gains tax, and try to do the same deduction, you're receiving less of a write-off. And if you give the appreciated stock, you're not paying capital gains tax, and there's over $7,000 more of use out there. So that's just one example of donating stock or a mutual fund or a capital asset outright and avoiding the capital gains tax as part of a larger donation. And you itemize, right? We'll get into a strategy called bunching here in a little bit, but it's just you just go in and you take the deduction on that bigger position, bigger capital gain asset. And if you really love the stock and if you have cash, buy it back immediately. It does start the holding period over, but now maybe that cost basis is a little bit higher. So when you do sell that in the future, maybe you don't pay as much capital gains tax. But in most cases, using something that's appreciated. I know we're focused on stocks and mutual funds, but it could be a business interest. It could be a cryptocurrency. It could be another asset that makes sense for you out there. But understanding deduction limitations, your adjusted gross income, could be a combination of cash and securities if it doesn't work out to be just securities out there. But it's just understanding, knowing that cash is not the only option. There are other options for charitable giving.
Great. And so now that we've talked about a few different assets to give and some benefits, I'd like to shift a little bit and talk about different types of vehicles people use for giving. Margot, can you talk to us a bit about options for supporting giving while living?
Absolutely. Giving directly to a charity That's the most common thing that we see. I'm sure all of you listening have given directly to charity at one point or another. There are a number of giving vehicles out there to choose from. They all have different benefits and different features, but the underlying goal is they help donors to be more efficient and more effective, again, each in their own ways. So outside of using credit card or checkbook, because we've already talked about that, donor advised funds and private foundations, they can be really favorable for giving during your lifetime. Private foundations, typically more involved from an administrative perspective and really reserved for those who have the time and large dollar philanthropy to commit both administrative resources and to oversee the operations. Donor advised funds were created as a way for more Americans to create smaller scale foundations to increase access without the administrative burden. If you're looking for ways to give and also interested in generating income, a charitable remainder trust, a charitable lead trust, these could be potential options as well. So when I'm meeting with folks, I'm always encouraging understanding the different vehicles and how they work. That's really important. Chris touched on this earlier. Every situation is different. So I think the most important thing is to do some self-reflection and identify what are your goals. So think about your time frame. Do you want to give while you live? Do you want to give after you pass? Think about your appreciated asset inventory. Do you have appreciated assets that could be good candidates to fund your giving? What is your tax situation? Do you have a need for income? Once you've had an opportunity to visit with these questions and really understand your circumstance, your goals, you can then have a really informed discussion with your advisor like Chris about the different vehicles that can meet your specific needs.
I totally agree and would echo that. With my work I've done with various donors, it's important to understand your short and long-term goals and work with your advisor to pick that best vehicle. So Margot, I think we both know that right now donor advised funds are the fastest growing vehicle in America. Can you share more about the donor advised fund and how they work?
Absolutely. The easiest way to think about a donor advised fund, think about it like a charitable investment account, and it works in 3 really simple steps: give, grow, and grant. This slide, it references the giving account, which is simply the name for our donor advised fund at Fidelity Charitable. So step number 1 is give. You have the ability to contribute into the account and are eligible for an immediate tax deduction. At Fidelity Charitable, we have no minimum to get this account started. Step 2 is grow. You have the ability to invest the funds based on your risk tolerance and your timeline, allowing for potential tax-free growth. That means just more money that can be given to charity. And step 3 is where you get to have all your fun, is grant. You have terrific flexibility to recommend grants out of this account to your favorite charities, and think anything from your alma mater to the local soup kitchen.
Great. And so Chris, when you're working with your individual clients, how do you work with them to identify the most appropriate vehicle for them?
Yeah, that's a great question. Margot brought up some of the first stages of just deciding on what do we want to do with our funds. Do we want to give it now? Do we want to get an income stream? Do we want to leave a legacy in a cash, pot that's to a charity later on down the road? A donor advised fund, fairly simple to set up. There's no special forms or tax reporting. We walk you through it electronically in most cases and just set up the account. More complex situations, charitable remainder trusts, charitable lead trusts, where maybe somebody wants to give assets into a trust now, receive the dividends or income during your lifetime, and then pass assets to charity, or a charitable lead trust where you gift assets in and provide benefits to a charity now, and then remainder goes to heirs after death. So it's just talking through those choices that are out there. Foundations are another choice, but I think the donor advised fund route would be the easiest. All other avenues typically have more administrative burdens out there.
Great. And can you walk us through an example?
I sure can. Yeah, one of the examples we talked about earlier, specific to bunching. Margot mentioned it, and I mentioned it as well. But think of bunching, and we'll look at the visual on the screen here. It means accelerating or giving 2 to 3, 5, sometimes 10 years worth of gifts into a giving account because you have an extraordinary income year. I mentioned some examples earlier where you have a big bonus, a stock option, exercise. You've sold some property, something where you have a big tax impact now that likely won't be there in the future. So you give a bigger or larger amount. You bunch several years worth of gifts into 1 year where you itemize and then take standard deductions in subsequent years. So in a bunching scenario, instead of just doing, $10,000 a year to charity, maybe you've got your STALT, state and local tax deduction, which right now is capped at $10,000, and maybe mortgage interest. You may not have all of these, but in this scenario, if you just gave the $10,000 a year, you get a little bit of tax savings, but you really haven't gone over that hurdle for the standard deduction. Whereas if you bunch $30,000 within 1 year, now you're way over the standard deduction and you end up saving another, $7,000 roughly more versus just doing it year by year. Roth conversions, that's becoming another avenue. You have a big tax year by choice, not by just a distribution or a sale of assets. You're choosing to realize some income sooner to get some money into a tax-free status, and you're looking to offset the income tax liability. So those are a few of the ways that we talk through bunching, but mostly it's you want to give for longer periods of time, but the need is now. You want to take the tax deduction now.
Thanks, Chris. So we've talked about those giving vehicles, but what about some other incentives like the qualified charitable distribution that isn't eligible to be used with a donor advised fund? Chris, can you explain what a qualified charitable distribution is and when they should be considered?
I sure can. This comes up for me as a financial planner in almost every situation where clients are at or approaching minimum distribution age, required minimum distributions. And just as a reminder, 401ks, IRAs, when you turn either 73 or 75, depending on your birth year, that's now the new minimum distribution age under the Secure Act. Previous to that, it was 70 and a half, age 70 and a half. So Congress, over the last decade or so, they've kept the qualified charitable distribution age as 70 and a half. So even though you may not be required to take money out at 70 and a half, you're allowed to. And this is the first year where that amount is indexed for inflation. For almost a decade or so, it's been $100,000 per year can come from an IRA and go directly to a charity or charities tax-free. Can't go into a donor advised fund. And this is another year where there's some exemptions where maybe it can go into a charitable trust. But in the basics are you're making a direct gift to a charity in this tax year. And the benefit in doing that is it comes right off the top of your income. It's not an itemized deduction. It just comes right off the top. And we'll go through some other examples here of why it may be important.
Thank you. And what are some additional considerations for taking advantage of a qualified charitable distribution versus using that donor advised fund?
Yeah, when I mentioned before, age 70 and a half, after age 65, you're subject to Medicare premiums and IRMA, income-related Medicare adjustment amount. So for a lot of folks, as you start adding up dividends, pensions, Social Security, and then eventually these larger minimum distributions, you may inadvertently be pushing yourself into not only a higher tax bracket, but a higher Medicare bracket. So now your healthcare premiums for one or both spouses, tend to go up quite a bit. So direct gift to charity just comes right off the top. Again, can't go into a donor advised fund, but the benefit is that doesn't even go into your calculations for Medicare adjustments. Whereas a donor advised fund, you're giving that cash or securities now to take the tax deduction, but you're going to be giving that money to charity over time and maybe not all in this tax year. The other difference is donor advised funds, a lot of people do use them as a legacy asset where you want the money to pass down to your children or grandchildren to make a decision what's important to them. What are they passionate about? It may be completely different than you, but you want to instill those values for the future. And it can also be easily added as a beneficiary to retirement accounts. That's becoming a little bit more common where the new rules on inheriting IRAs is a lot of people have to take that money out within 10 years and it's taxable to them. So now you potentially lose the ability to do a charitable distribution for heirs. So a lot of complex strategies in there, but I think the basics are QCDs are beneficial to help not only avoid taxation, but maybe lower Medicare premiums.
Thank you. And I think we have just a few minutes left, so maybe we can take a few questions from our audience. So Chris and Margot, here's one for you. I am a pre-retiree and have some concentrated positions in my portfolio. How can charitable giving help here?
I'll take that one, Elizabeth, here. It's a common question here in Houston, famous for oil, famous for, a lot of cash distributions, but also a lot of stock distributions from restricted stock awards. And when that comes in, that's taxed as ordinary income. But a lot of people do sit on those, sit on those shares for years potentially because they're working and they don't want more taxable income. But it becomes a concentration risk, right? As you've got too much company stock maybe out there. And we talked earlier, what's the alternative? You sell that stock and give cash or give the appreciated security. The other avenue it comes into is when people inherit a position from mom or dad and they worked at a company for years. Maybe it got a step up in cost basis, but they passed away 10 years ago. So giving appreciated stock, it's the same concepts we've been talking about, but I also look at it as a risk mitigator, is you're trying to reduce your risk in something that's very, maybe not illiquid, but very tax sensitive to get out of.
And I'll add in, Chris, a lot of times we see folks in that pre-retiree phase using the strategy of bunching that Chris talked about. So in those years where you have income to offset, use that concentrated position to front load some of your charitable giving and create this ready reserve of charitable dollars that you can leverage throughout retirement. What we see at Fidelity Charitable is when folks retire, oftentimes their second act is getting really involved in nonprofits, and we see folks looking to increase their charitable contributions throughout retirement. So having this plan, having this thoughtful approach can help somebody be really well prepared to do just that.
Perfect. I think that might have been the only question we had time for, but I'm so glad we got to squeeze an extra one in. Chris and Margot, thank you so much. You've given us a lot to consider. Would you mind sharing just a few key takeaways each that you'd like to leave us with?
Yeah, I'll start off, take action, right? I think we can put things on the back burner and say we'll get to it later, but don't wait till year end. Holidays are going to come, election will be here, top of mind maybe here in the summer, and with taxation, get it done. All of those other things are going to be happening, but make a decision. I think that's the key. And first, internalize too. What is your goal? What is your passion? Have that family conversation first, but then talk with an advisor and we can come up with an action plan.
My turn?
Your turn, Margot. Yeah.
All right. My biggest takeaway for you all is to act with intention. So Chris gave us so many different strategies to think about. I could not agree more about not waiting until the end of the year, but I encourage you all and I challenge you all to think beyond cash. Review your portfolios, think creatively, think strategically. By doing that, you can maximize your charitable impact. And don't forget, right asset, right time.
Thank you both again so much, Chris and Margot. We really appreciate you taking time with us today and sharing all those wonderful insights on how to make more of a difference this year. So for everybody still listening, we've got some great resources available for you, including Fidelity's webpage on charity and philanthropy and the many ways we can support you on your journey, in addition to an event series where you can connect with a Fidelity charitable representative to ask questions and see a demo of the giving account experience. Lastly, we'd really appreciate if you could take a brief survey and provide some thoughts about today's program. So thank you all again for joining, and we look forward to speaking with everyone soon.